Folks, we might have a problem. Bank of America's top global strategist just issued a dire warning to all of Bank of America's clients. And I want you to know about this warning as well. So let's look at this article by Business Insider. And the global strategist, his name is Michael Hartnett. He's a smart guy. And he's saying and advising clients that they should sell stocks at the Federal Reserve's first rate cut. Now, many of us have been looking forward to the first rate cut. So what's Michael worried about? Hartnett's analysis of past rate cutting cycles shows that stocks fall during what he calls hard landing cuts. So Michael's worried that maybe the Fed has taken too long to start cutting rates, and now we've set ourselves up for a hard landing and potentially a hard recession. And he goes on to say, Hartnett goes on to say in this Business Insider magazine, summarizing that recession risk have been underappreciated by investors. And I would say dramatically underappreciated. So let's go through this article. Hartnett said global central bank rate cuts are signs that the economy is in for a rough stretch. Now remember, the central banks of all the various countries in the world, they have access to information that you and I don't have. So if the central banks are worried, we should be worried. Now, in this report, he shows that in 2009, there were 76 rate cuts that happened. In 2020, during COVID, there were 92 cuts. And as of July of 24, you can see it's one of the highest peaks here. There have been 35 cuts so far, and the United States' central bank has not cut rates yet. Hartnett goes on to say that Bank of America also expects for the next 12 months going forward that corporate profit growth they're expecting it to fall by 50% from July to December. So he's showing that in July of 2024, corporate profit expectations are 11%, and Bank of America is showing that their forecast is that growth rate's going to fall from 11% to 5%. Hartnett goes on to say that the rise in unemployment rate to 4.3% has officially triggered what's known in the industry as the SAM rule. And the SAM rule basically says that the U.S. economy is already in a recession when the 3-month moving average of unemployment rate rises by at least 0.5 percentage point from its low point over the previous 12 months. Now, we know that right now unemployment's 4.3%, so it's already risen by over 0.5%. And he goes on to say that recessions have already started before the indicator is triggered, right? It's what we would call a trailing indicator. It's not a leading indicator. So the SAM rule, and if you look at this chart here, it's got a perfect track record of indicating when we're already in a recession, whether the government says that we're in a recession or not. Okay, so let's keep going. On top of all this, Hartnett says that recession risk have been underappreciated. They have the Bank of America's July Global Fund Manager Survey, and it shows that money managers were assigning just an 11% chance of recession for the next 12 months. And I think many of us, what we're seeing in the real world is the likelihood of a recession, I think, is dramatically higher than what only 11% of money managers are predicting that. And I'm not saying we're going to have a recession, but I do think that risk is underappreciated. Stocks are being priced for, you can look at their price to earning ratios, many would argue, and I would agree, I don't have a crystal ball, but things are priced for perfection. Speaking of no crystal ball, I should say this is not financial advice. It's not investing advice. I don't know your situation. I can't give you that, but I do want to put this on your radar screen because the research team at Bank of America is a group of smart folks. As I said, Hartnett is one of their leading global strategists. And the stock market, look at what the stock market has done. The S&P is up 32% for the 9 months heading into the end of July. And historically, That number's averaged just 2% since 1970, heading into rate cuts. Okay, so that's what Bank of America's worried about. That's what HeartNet's worried about. Thank you to Business Insider for this. But more importantly, what should we all be doing based on this information? You know, the challenge is it's time in the market that helps us succeed as opposed to trying to time the market. So we have what we're worried about. We're worried about a recession. We're worried about a difficult time for corporations. We're worried about corporate profits starting to go down. We're worried about all of those headwinds and what that means to our investment portfolios. The challenge is not only do we have to get right what potentially might happen, a recession, and what the fallout implications are, lower profits, but then we have to get right what's the market going to do? Has the market already priced this in? You know, sometimes you can look at it and say, I do think the market's priced it in. And as HeartNet mentions in his study, typically going into the first rate cut, the market has only been up 2% in the 9 months leading into that. And so first off, why would the market be up 2% leading into the first rate cut? Well, I think that just like we're feeling right now, people are looking forward to those higher rates starting to come back down, which lower interest rates should stimulate the economy. But the question is, why do we need to stimulate the economy, right? We're still fighting inflation. The reason I think HeartNet would argue that we need to lower rates and stimulate the economy is because the risk of a recession is increasing. And remember, the Federal Reserve has what's called a dual mandate, not just to keep inflation at bay, but also to keep us at full employment. And right now, the Federal Reserve, with unemployment rate increasing, they need to be more concerned than they have been in the past. And I've said in previous videos that time is not on the Federal Reserve's side. We started this rate hikes. We started that period of higher interest rates with historically low unemployment. We started it with really strong growth, and we started it with excess capital in the system left over from the stimulus of COVID. But now that excess capital has all been spent, right? The consumer has spent that money, and all that pent up demand from when we were in COVID and couldn't do the things that we wanted to do, that has died down. We're certainly seeing that in the tourism industry. I was just reading the other day, Hawaii's tourism is not as robust this summer as what the tourism industry in Hawaii was predicting. So we're seeing people start to pull back. We're seeing that COVID surge, you know, when we could finally start spending money again, we've seen that pull back. So again, getting back to what should we do? The challenge is predicting what's going to happen is hard. I don't have a crystal ball. I don't know, maybe you do, but if you do, there might be a crack or a flaw in it. So we don't have crystal balls. So what's going to happen with the economy? And then importantly, how is the stock market going to react to that? So I'm not a fan of timing the market. I'm a fan of doing things that are easy. And when you look at stock charts, and stock charts for the most part go from lower left to upper right, and what that means is over time, companies tend to do things better, faster, cheaper, and their earnings grow because of that. And that's why when you look at a stock chart, it tends to go from lower left to upper right, which is what we want. The companies are getting more valuable. So time is in your side if you're willing to let time work for you. But boy, it can be really, really hard to try to time the market. In fact, I think you have a 20% likelihood of getting it right if you try to time the market. And why do I say that? Actually, I say about 1 in 8. And the reason for that is I think it's a coin toss. Are we going to get into a recession or aren't we? None of us know. So it's kind of a coin toss, although that rule that we talked about earlier, the SAM rule, has a great track record, and the SAM rule has been triggered. So I'm more comfortable that, you know what, we very well might be in a recession. It might be what I call a rolling recession, where certain parts of the economy are getting hit at different times. Certainly we saw technology taking a hit. We saw technology employees really for the first time on a broad basis suffering from layoffs. And I think there's been other pockets of the industry, of the market, of the U.S. industries that have been hit at different times. So what do? I think what we do is we go back to the basic fundamental building blocks of getting yourself in a position where you can retire, where you are investing successfully. And that is come up with a long-term asset allocation that you can stick with in good times and scary times, right? We all want nothing but positive weeks, positive days in the market. But unfortunately, not just are drops in the market a feature of the market, it's not a bug. Not only is that, but big drops and quick drops are a feature of the market. There's a saying that the stock market takes the escalator up, takes a little bit more time to go up, but then it takes the elevator down. And what that means is things come back more quickly. And just as I'm posting this just recently, we saw that play out. So what should we do? Double check that your asset allocation is correct. Be able to withstand what kind of drop your asset allocation likely is exposing you to. If you're 100% stocks, I think, that's at least a 20% drop that you potentially could be exposed to. And it has happened in the past, as recently as the great financial crisis, 2007, 2008, 2009, from peak to trough, from high to low, the S&P 500 was down almost 60%, 60%. So that's the type of risk you're taking in an all equity, all stock allocation. And so decide what percent is right in stocks. And then for bonds, as we saw in 2022, we have to have the right kinds of bonds. Bonds can be volatile, and that's why I like high quality, shorter duration bonds that are going to mature in 1, 2, 3, 4 years, duration like that. So that's what I think we should do, is get our asset allocation right. Nothing I'm sharing today is financial advice. I encourage you to work with a fee-only fiduciary financial advisor that's working for you. Get that asset allocation right and be able to ride out whatever storm we may or may not see. So thanks for watching this video. If you like this video, I think you'll also like the video where I talk about enjoying the journey until retirement. It's not just about getting to that finish line, but it's about enjoying the journey. So 8 things to stop doing in your 50s and 60s in order to enjoy the journey more. Thanks for watching this one, and I'll see you in that one.